All right, guys. Another Tuesday, another coaching class. We're in a conference room. It's October the 13th, 2015. What do we have? Just real quickly, you know what's going on, and it's up and away because the Fed's going to introduce QE. Last week, with the minutes that came out, it was more of a dovish interpretation, which is giving equity markets a little bit of a bid. Then we roll into asset allocation. Stocks and bonds seem to be going opposite. Even though there's headwinds with China still on the radar, they seem to shrug that off. It's not that it's super strong or now we're in a bullish uptrend forever and we're going to retest the highs and everything. It's just the correction within the correction. So big correction over the last couple, 3 months down, and it's these corrections within the correction, the best way to do it. But they could be wicked if you just play it from the short side for the last 2 months, right? You can't just sell it and expect to be, hip, hip, hooray. So this meeting is going to be about risk management in real time. George and I touched on it in the trading room yesterday, and it really I think resonated with some guys that thought it'd be a great group coaching session. I agreed, so I want to do it right away to kind of give guys a sense of more detailed ways to manage your risk rather than the general stuff. Let's go to a sketch pad first. Why are we going to go to a sketch pad? Because it's a where is this at? We're going to go and say, all right, everybody has this 2% rule. Don't ever risk more than 2% of your account. I think that's great for reading books, right? That's great for general stuff. It's general, though. That's what it is. Too general. It's tough to understand. Plus, it creates too much, in a way, of an arbitrary approach to manage your risk. If you are just going to risk 4 ticks, 6 ticks, I think that's good to practice. I don't want to risk more than 4 ticks, and don't risk more than 4 ticks. But know where you're getting out before you get in. I'll say it again. Know where you're getting out before you get in. That's how you measure your risk. That's how you help calm yourself down when you're anxious and miss too many trades. If you know where your exits are before your entries, the sense of calm comes over you. And one of the stories I told was if you're walking down the street and you know where the monsters are, you might not be as afraid when they jump out at you. Same thing. If you know your exits, you know your risk is there. I'm wrong right there. I'm wrong right here. And you end up being wrong, which you're going to be. You're not as surprised. If you're not as surprised because you know it's part of the business, you're not as emotional. You give yourself a better chance to be objective while in the trade. All these general stats and everything never take into consideration that you're often a different person when you have a position on than you are when you're reading the book, when you're studying the strategy. You've got to work on separation between your mind and yourself. They're two different people. If you listen and follow what your mind is telling you, you're going to be a loser in life and in trading. You've got to detach yourself and not let anybody tell you how to think. You tell yourself how to think. You tell your brain what to think. So if your mind's always going to do what it's supposed to do, and that's protect us. It's going to try to make us feel good. If you're a drug addict, it's going to try to get you drugs and rationalize why it's okay to drink and you're an alcoholic. It's going to rationalize why you shouldn't get out of a loser because you feel bad when you admit that you're wrong. And you're not wrong until you exit that trade. So all this risk management skill set that people come to think that they know in life and then into trading is usually either way wrong, way off, or way general. What do I mean by way general? You can't implement it. I can't fly a plane because I know that there's 2 wings and you need some airspeed and then it goes up. All right, some basic reasons why you can get something to fly, but I can fly it. So what's the real-time risk management? What do I need to do real-time to help manage the risk, which all in one will help you guys feel less anxious and miss less good trades. Let me repeat what we talked about last week, and that is a great way to review is to go over missed trades. Gary said he was doing it he's a real successful crude oil trader. It's helped him immensely. He was doing it before I mentioned it last week, where instead of just going over losing trades, training your mind to just focus on bad trades, train it to focus on missed trades. Said a long time ago, my worst trades are missed trades, not actual losing trades. In fact, you could find, in a sense, that losing trades are your best trades because you keep them small. You don't add to them, and it's not a catastrophe every time you take a loser. So, in a sense, you're reviewing missed trades, and so you're really training your mind not to miss it, to recognize something you might have missed or something that you just couldn't pull the trigger. Remember, missed trades aren't always opportunities you didn't see. They're opportunities you saw, you were ready to execute, you didn't, and it would have worked. Those are the killers. It's one thing when you try to, it's not as bad if you didn't recognize it. All right, now you got to get your skills up a little bit to try to focus on what you missed and so on and so forth, and that's it. But if you recognize it, you've seen it and you didn't trade it, that's the ones you want to review because you got the skill in recognizing it. Now you need the skill to execute it. Risk management, real-time risk management, which is the title of this session, going to help you guys do that. I think a little bit more. I think a lot more for some people, and everybody's a little different. But this generalization of how to manage your risk is wrong. It's not easy to implement, and therefore people don't implement it. So let's get into some, and here's, I got some obvious things that I'd like some of you guys to do, not all, but 2% of your trading account, that's fine for an overall investor. Maybe it's even fine, if you're really getting into a bad stretch of trades during the course of a day or a week. You want to have some laws to say I don't risk. The problem with this number is people, they're trading rules, they're not laws. Let me go over the whole, anytime we talk about risk, we have to talk about consequence because I'm willing to take certain risks. Every time I trade, I'm willing to take certain risks. Every time I drive, I'm willing to take certain risks. I tell the story over and over again. I'm willing to go down and do 50 or 60 in a 40 because even if I get pulled over, even if I get a ticket, it's not that big of a deal. But I'm not willing to run over a guy who rides his bike in the street because I don't like guys who ride their bike in the street. Even though I don't like it, I know I'm going to jail if I do it or if I get caught. So I don't do that. That's a law and a rule, and you got to know the difference. You're going to break rules all day long. That's what we do our whole life. But you're not necessarily going to break laws. Okay, so separate the two. When you create your risk strategy or your risk parameters and everything, separate the two because most people think rules are going to keep them like focused. BS. Here's what rules are. It's like parents that telling their kids, here's the rules, here are the boundaries. Then the kid goes across the boundary and there's no consequence. Then it really wasn't a boundary, was it? All it takes is one or two breaking of the rules, and they're no longer a rule. Think about, even if it's still a rule, even if it's still hard and fast, I got to focus on that rule. Once you start breaking it, your mind says, ain't really a rule. Just like kids do with their parents. Yeah, they're not really that serious about me fighting with my brother because I do it, and they don't tell me, they don't follow through, right? There's no consequence, therefore there's no boundary. Rules stink. So have some big laws that you don't do. When working with a guy who he says, he would trade really good and he'd always have one day, which was one trade, not one day, one trade that he'd lose 5 times as much as he would make. But he says there was always a moment that I could have caught that loser way short and still had enough preserved capital to pay for that risk. Meaning once it got over $3,000 or $4,000 in that particular day, in that particular trade, if he would cut it every time he had that day, he'd be great. He'd be making money. He couldn't do it though. There was some psychological wall that he couldn't get through. And it was, that's when I came up with the law. I says, you can't do it. You get fired. You have a boss that says, whatever you have to do to say you don't move your stop, that's it. $3,000 and that's it. I said, that should be easy. And it wasn't. He couldn't get past trying to get the $3,000. And it's not like he got the $3,000 back. When he said, when I'm down over $3,000, I could never get it back. Well, I said, if that's not as clear as could be, what would be? I said, if you can't do that, quit. Because you can't then listen. You can't follow any kind of, you're not disciplined, period. Now let's get back to the sketch pad. We started by saying that, and George then interjected and said that's one of the most important things of all, and I'll try to get back to exactly explaining it the same way I explained it in the room, but it's like, if you get short, let's talk about getting short. If you get short at this black dot here, right, and you say I'm going to risk 4 ticks, well, that's fine. You could risk 4 ticks, which would bring you up to this price line, That's a stupid picture here. Let's do it again. This is a short. You're short there at that black dot, and you're going to get out at a -4. You don't want to risk more than 4. Kind of arbitrary. Why? Because at -6 is market structure, and where really the longs aren't nervous anymore. See, when you're short, in order for it to work, you need the longs to be nervous and stay nervous. They're not going to be nervous, and now the shorts are going to be nervous above what happens to be a -6. The market doesn't care that you're going to risk 4. Market does care about this line if you're good enough to know where the transitional moments might happen. And you hear me say in the room all the time, we're bearish until we get above a certain price. We're bullish until we get below a certain price. The bears don't want to see it to get above here. Well, in that case, you don't want to see it get above there if you're short from this black dot. So now your risk really should be 6 ticks, not 4. Now, get it, I'm not saying your risk should be 16 ticks. Maybe it should, which means you shouldn't be short from here. If your true risk is too far away, your location's probably too aggressive. Make sense? So you got to first know what the lines in the sand are, see how close you can get to it, and that's how you manage your risk. You could use a -4 arbitrarily, but realize you're going to be right a lot, get shook out at a -4, and then have it go down. Because your -4 was this arbitrary line in the sand and not the true market structure. What profilers mistake all the time is they get good at understanding market structure. They get good at knowing who's in control, but they get short down in here, and the bears are in control all the way up to there. Well, you short from down in here, guys, and it's trading like this, you're sweating your you-know-what off. You could eventually be right, but boy, was this a bad location. Chances are you're going to get shook out, not make money, and be right, or just have to sweat it out because the better location was either up here or something that showed you in real time where to get short. Transitional moment as close to that, line in the sand, you could call it if you want, whatever. And now you have a better sense of real risk instead of the arbitrary 4-tick risk. And if, let's erase the drawings and go back. And if your line in the sand is up there, you got to be good at lines in the sand too. But if your line in the sand is there and you want to get short down in here, you better realize that either be willing to risk this much, but if that's too much, know where you're at contextually, okay? Know that you're playing, with a little reach. You're reaching, okay? And understand that maybe I take some small losses to keep my powder dry because I might end up having to sell it again and put them back out up there. And know that I want to be right sooner rather than later, or a short leash on this trade, because it could really go to here and I could still be right. But boy, I don't want to still be right and be short from down in here. So I want to keep a short leash on it. That's when you know, hey, I know I'm kind of in an aggressive spot to get short, when there's guys short probably above me in better spots. And after all, this is the true line in the sand of where guys are going to defend that bearish bias. Okay? Are we kind of on the same page? Does it kind of make sense how you strip the randomness or the arbitration out of setting your risk? It doesn't mean that you don't have to have small risk, but you get a better sense of where the lines in the sand are than where you're at in a contextual way versus where other guys are. You don't want to be short with other guys, and you certainly don't want to be short after other guys like you. If you're short after other guys like you, they're short better. If they're short better, that is. They're buying it where you're selling it. They're buying it for a profit where you're selling it. You got a short up there. He's short. He's whistling all the way down in here. You decide to get short down in here. He buys it from you for a profit from there to here. And then everybody else buys it back up to where you should have got short. Now you take a loser. And guess what? That's a market taking money from you and giving it to me. Closer to resistance, but also what I want to say, someone said, first of all, someone said the sound stopped. You guys still hear me?
Yeah, I do.
All right. Let me just tell Jim that it's on his end.
It could be on his head, on his
headset. I'm not going to make any elderly jokes, especially he can't hear me. Oh, no, now he's good. You heard it. Sorry, Jim. All right, so someone makes a comment that just closer to resistance looking to the left. Not always, though. It's not always that simple because that resistance could change, or it's sometimes better to be shorter, lower. But to keep an eye on where you're thinking of getting short and where you really, market structure-wise, let's keep it simple, are wrong. And the distance between the two should be focused on what your real risk is. And it'll help you. It's going to push out your risk, which should push out your reward. But I think it's going to help people be in better locations, identify good locations, be more comfortable when you should be more comfortable, be less comfortable when you shouldn't be. There's nothing worse than being comfortable when you shouldn't be, and because that's false, right? That's false hope or false sense of security is a better phrase for it. It's like being on a roller coaster and you think you're strapped in when you're not. That's pretty dangerous. So it'll help you feel comfortable when you should, and then also get yourself into a location that you identify real time, because you've got, and the better real time line in the sand is one that just showed itself not too long ago. If you have if you have a line in the sand that people have seen for 72 months, more people have seen it. You don't want to be stuck with those people. But anyhow, hopefully, and we're going to talk about this in more detail on charts, and George's going to chime in. Hopefully that made sense. And, I'm a guy that doesn't like to ramble on, and sometimes it's part of hosting a presentation. It's harder to listen to someone than it is to talk. I get that. That's why it's recorded. Go back and listen, because I said some really important things that if you weren't paying attention, watch the recording. So let me go back into this and go to another slide. The where, why, and what now. Okay, what do I mean by that? Well, where are you wrong, which is getting out, knowing where you're going to get out before you get in. Where are you wrong? Why are you wrong there? These are answers to questions you should have. Where are you wrong and why are you wrong there? Arbitrary exits are fine for scalpers, so they're better to get out, and they're not really that arbitrary for scalpers because where you get in is very sensitive to a scalper. Cover that more when we start talking about the trading plans for scalpers. But they're fine for one or two tick losses if you're scalping it. Losses if you're scalping it. But as you're more of a 2 or 3 or 4 trade a day position type of trader, you obviously don't want to get chewed up. And then here's something that's interesting. For some of you guys, this might apply. For others, it might not. Maybe start, and by the way, the attendance in these meetings have been great ever since we started it. It proves to me, people always tell me these meetings are great, blah, blah, blah. And I'm thinking, well, all right, that's great, and I appreciate that. But to have actually people come here, it's actions following words. So these meetings are good. Keep coming and keep watching and recording. So anyhow, maybe start getting in where you are getting stopped out. If you're having trouble and you seem to be just the fish in the bottom of the barrel instead of shooting fish in a barrel, then when you want to get in, don't. Get in where you would have got out. Some of you guys might think I'm talking directly to you, and I don't know who this would be addressed to, but if I feel like I'm talking to you, good. Start playing that way. If your locations are bad, something's wrong. And if you're always getting in and getting stopped out quick, there's no doubt it's a bad location. If you're getting stopped out quick after you open a position, it's a bad location. You're in with a lot of other people. There's something wrong. Get in where you would have got out. That doesn't go for everyone because some of you guys are doing really well. It goes for those that just aren't getting that location out or down. Now, if this is really applies that if get in where you would have got out, especially if where you're getting out ends up bouncing and going back to where you got in. So you get in, you get stopped out, and it goes back to for what it would have been a break even. Does that make sense? So do your best at understanding exits before entries. Don't ask me, and nobody's asking me this, but don't think to ask me, well, what's more important? Because sometimes one is, sometimes the other is. Like I've said before, everything's important when you're risking money. And when you trade, you're risking money, and you're doing it a lot. Everything's important, right? Your disposition, what you feel like, how you're doing, what kind of people you got around you, what kind of support you have around you, your actual decisions to get in and out, if you're over or under capitalized, everything. Everything. I don't have to wear a button-down shirt, but sometimes I like to feel good when I dress a little nicer. Plus, I'm going to a wake later. But the point is that feel good, keep a clean desk. Everything's important. Don't try to science it up and put too much weight on. Because as soon as you put too much weight on entries, because in that particular era of trading or month of trading, entries were really important for whatever reason, it'll transition and exits will be more important, and you were too late. Retail people will always buy stock markets over the summer before Greece and before China, right? They'll always get pushed in at the end. In the housing market collapse started in early 2007 when when the subprime started to lighten up in very early 2007. And the crash really didn't hit and became everyday news to financial or business channels until August of 2007. That was middle of August 2007 when the housing meltdown became everyday news to financial channels and business channels. It was the Dow was down big, and that's what they attributed it to. But in February of 2007, they did a story on CNBC, and it was that, I can't think of her name, and she did it about the subprime, and it was just, they were just tapping on, how it might be, a little tough right now, and they're not giving as many subprime loans, blah, blah, blah. That was when it was getting close to really pulling the carpet, March, April, the spring of 2007, when all of a sudden the carpet was pulled out from underneath everyone. Anyhow, I'm getting into that because if there was just a real big push in late 06 to get a lot of people into houses. Not that they knew that things were going to come to an end, just a market being a market, you know what I mean? And wham, it's like that's why the crisis was worse than it would have been, is you just had that big, just fill it up and pop. And it's that last push at the end, it's that big roar and then wham. And that's what happened in late 06 to really make that 07, 08 housing meltdown worse than it would have been and whatever. But let's get back to the where, why, and what now. Where are you wrong? Why are you wrong there? Exits are only good arbitrarily if you're a scalper. And maybe start getting in where you're getting stopped out. Get in where you would have gotten out. Use the market chart. One thing I wanted to add, though, is what was the question I asked that just made me think of, what's more important? And someone might ask me this. Well, when is a particular scenario or month or week of trading where entries are more important? When it's volatile, I think entries are more important. You got to get in. And then what happened? I just want to get in. It's rallying. I got to get in. And those are more important. And then the exits are still important, don't get me wrong, because you got to get the hell out. And I shouldn't even say it that entries are more important. Getting in is important. Getting out is important. You can't wait to get out when it's volatile, but you can't wait to get in when it's volatile. What I mean by that is if you wait when it's volatile to get in, you will miss it. That's why entries are really important when it's volatile. Now, entries or exits are also important because if it isn't going where you need it to go in a volatile market, you got to get out pretty quickly. But if you're getting good locations and you're trading somewhat well in a volatile market, you could be, you could kind of sit back and be like Eddie Murphy and Dan Aykroyd in the movie Trading Places when they were exiting their position, and they were just calmly able to sell it, or buy it back. I can't remember what the hell they did. Either way, it's playing in volatile markets. If you're grabbing an edge and getting on the right side of the market, it's obviously easier to exit winning trades than it is losing trades, but entries are important in volatile markets because if you wait, you miss a lot because the market's not going to wait for you. Hopefully this slide makes sense, the where, the why, and the what now in assigning where you're going to get out. It's not a phrase I came up with. Know where you're getting out before you get in. Let me wind it down with this and I'll hand it to George. When I was an ARB clerk, okay, I already did the quoting exercise because it was an ARB clerk. I already knew how to quote. I already knew how to watch ancillary markets because I'd look at the board at the bonds. They were quoting the bonds on the board, right on the floor. And if the bonds were going up, meaning they were plus 10, plus 11, plus 12, plus 13, I'd be careful showing my offer. Okay? I would say small 3 offer because the 3s are going to trade in this market I was quoting because the bond. So anyway, I didn't have to do the quoting exercise that I rolled out earlier in these coaching sessions. But what the guy told me in this pit trading class, what he told the class is the exercise that we do is going to be based on just scratching trades. You're a shortstop in baseball. If the ball is hit to you, do you know where you're going with it? I remember my dad telling me that when I was in Little League. But the guy that the instructor of this class said, know where you're. So the only exercise we did was scratching. You'd be in the pit. You bid 2 because if the brokers were bidding 2, you were bidding with the bidders and offering with the offers. So you were bidding 2 bid, and a broker would say, sell you 2. You need to go to another broker and say, sell you 2, right? If you get sold 2, you have to sell 2. Means you bought, right? So you got to know where you're going. And so I'm bidding 2s, and if someone hits me, I know I'm going to go to this guy or that guy to get the hell out. And then they just kept doing that. But then the brokers started moving the market around. So if you couldn't get out for a scratch, just get out. And that's how they kind of advanced the exercise. But my point is he came up with know where you're getting out before you get in. It's kind of what this real-time risk management's about without being too scientific. Know your exits before your entries. Now let's look at a chart, kind of create a little more structure to it. And by doing that, let me put my charts over this. Let's just go on real-time action today. We'll take this into a candlestick bar. We had price action that you can't see. We had price action that you can't see in just in looking at a chart. Even just a footprint, you're going to have to watch it dome and see the speed of it real time. But you had a divergence with the NASDAQ making highs. You had a price action where you shook out the shorts and got some longs in. But bam, when you had this, you had a sense that this was a head fake all up in here, and you got that reversal of rejection. Now, if you were to get short, let's go back to the risk side of it, real-time risk. If while we were talking about this in real time in the trading room, if you're able to get short, in the further down this bar you get short, the more you have to risk because you're not wrong until they come back all the way on this bar. The closer you could recognize this is a reversal, the less you're going to have to risk because you really don't have to risk any more than the 14. If it goes back to 14 and above, that's where your buy stop would be if you're short. So if you're short at 13.5, you're only risking a few ticks. But if you get short at 12, You're still not wrong if it goes to 13, 13 half. You got to risk more. If you only risk 4 ticks and you get short at 12, you're probably going to get stopped out, and it's going to do this. Boom, it's going to stop you out, and it's going to go, right? It's going to stop you out and go because you're arbitrarily working. The market doesn't care or know that you waited to down here to get short at 12 even, than when it was recognizable to get short a little higher. You're not wrong, though, until it takes out where the transition kind of started. Now you're not using arbitrary places to get out. You're using market structure. It really shouldn't go back up to where my cursor is if it's going to remain weak, and it did. And then it had a downside magnet, blah, blah, blah. Went to 10, chopped around, went to 7, 8. And since we've been doing this session, it's done absolutely nothing. It's chopped between 8 and 10. 10 was a big moment because it had some magnets. It had some magnets down there. So that's an example of how to apply this. Once you get that transition, you could it's not where you get in, it's where you're wrong at, and then you manage your risk or you assign your risk from there. Let's go into here and say, let's say this is a place where you're bullish because it ran up, and at some point it's like you got to realize that at some point, given the context that we opened up at 99.5 below yesterday's low, that a lot of people are going to try to sell it. And the longer the fight to go up or down, like here, the market doesn't know it's going to 14 in here. People think that they know, that the market knows. And how could I know what the market knows? That's trying to search for a crystal ball. Inside this noise in here is a fight. They're trying to get it to go lower. There's a chance it goes lower, just like the game. You don't know what the outcome of the game is going to be. The longer the fight, the better the chance you have more continuation when the winner is identified. Okay? So the fight. You could start saying once we get into yesterday's range, the longs are in control and they got some upside, and you pull back to a thin spot. Well, the closer you can get it to you're not wrong until it jumps back underneath this VWAP and a couple ticks underneath this thin spot. So if you get long at 04 or 0375, you got to risk below this thin spot. If you risk just 4 ticks, you're going to get stopped out where you should get in. You're going to get stopped out on your 4-tick loss, and guess what? That was the dead low of the move because the thin spot, right? So if you get long at 14 or at 0375, that's fine, but don't get out where you're not wrong yet. You got to risk more, or don't. If it's too much risk, don't buy it there. If it's too much risk, you're going to have to wait. You're going to hopefully it comes back, get in at a lower price or a better price, and then. But at least you know what your risk is, and you're good at trying to anticipate where someone else is wrong. And, start like this. Try to take what is obvious as an exit for others and say that's where I'm kind of wrong. Be a little ahead of those guys so you're not stuck with the herd. But the closer to real time you could get to assigning a line in the sand, it usually means that you're not wrong with a lot of other people. It just means that there wasn't as many stuck shorts as you thought or that you needed. So if you buy something and get long and you're good at assigning value, when you're wrong, it usually is because there weren't enough stuck shorts to run it up. It doesn't mean every guy in the world was long with you and you're all wrong and that's why it went down. It just wasn't enough of the stuck shorts as you needed for prices to advance higher. That's when you're good at trading. When you're wrong, and that's why it'll help you guys to be wrong easier. It doesn't mean that you have to feel like you're on the playground and everybody's laughing at you, or you're in the classroom and you're at the chalkboard and you get it wrong. Everybody, not only do you get it wrong, but the teacher and the kids are laughing at you. If that's how you feel when you be wrong, you'll never trade. Or you'll never trade successfully. But you have to know that, hey, I was wrong. I was wrong not because I just was bad. It's just I didn't have enough stuck shorts in this idea it was going up that I needed for it to go up. That's all. All right, where do I know that at? Okay, 3 ticks lower. So I could risk maybe 4 ticks. And maybe I only want to risk 1 tick on a third of my position, the way I trade, and keep a short leash on the first third, whatever. You could adjust to it. But overall, you know where you're wrong at. So number one, you're not risking any more or less than you should, but you're not adding. So you're wrong if it goes down 4, 5 ticks from where you got in. So you're not like buying at 8 ticks lower from where you got in, buying more at 12 ticks lower. It doesn't roll into staying wrong. Okay? Being wrong and staying wrong are two different things. One's a professional method, the other is a retail method. You know, and I'll tell you a quick story and I'll give it to George. Driving down the expressway, I take a wrong turn. Block later, I said, shoot, I took a wrong turn and I made a U-turn. My wife, I always make fun of her because she always makes wrong turns and she goes, see, you can make mistakes too, make a wrong turn. I say, yeah, but when I'm wrong, I'm not wrong for long. She called me a 2-syllable noun or adjective and we went on our way. But if you're not wrong for long, you're in a better spot to manage your risk and not do it arbitrarily, and then feel good not to be anxious and miss too many winning trades. Do this, though, so don't forget to say this. Study and review your trades based on what you missed, what you recognized, and what you didn't pull the trigger on. That's going to help you more than just going over your losing trades. George.
Yeah.
You want to take the screen, show a couple things?
It like in context of kind of placing your stops where market structure.
Yeah.
Yeah.
Okay. My throat's
all right.
So let me I'll put my mic on mute, and then you can take it away.
Okay.
I see your screens too, by the way.
All right. Well, this is kind of a chart I like for market structure, mainly because the POCs and you can see highs and lows, and you could also kind of interpret if they're stuck buyers or sellers. Well, I mean, for the time being, let me give you some hypothetical trade ideas, and then let's see how we could market's actually kind of set up to actually make a move now, which is kind of good. All right, so let's say you were bullish, right? And after this market transition lower, and you're still bullish, but just because you're bullish doesn't mean you have to buy it like right now. If we like scroll back, right, we have reasons to be bullish today, right? We have an uptrend. All the sellers got, absorbed and prices went higher pretty much ever since the open. Let me give you like a scenario of how, like, I would, like let's say I had a bullish bias, right? And if I was still like bullish in this chop, basically, I would look for somewhere to risk to. So this would probably be the spot I would risk to. So my stop would have to be somewhere below here. And then you could assume that, if the market stays above here, I had like trap sellers here. And what I'm trying to do is like buy it as close to here as possible. So when the market was like in here and came here, either I missed it or I would have to risk more. So that would kind of determine how much risk there is. But on the flip side, okay, so let's say I'm an anxious bull and I need to get in. Well, I know I'm at least I got a risk to below 475 at that time, right? So I know my risk price is here, right? This is what you got to risk down to because, if it trades below there, then maybe you're going to test the intraday low or whatever. So that's kind of like your line in the sand. So you're risking to below there. But what's your upside target at this time before it happened? Was there something in the market that was potentially an upside target? So depending on the way that the order flow is going or whatever, you determine, well, is it worth this risk? Because if I'm buying it at 6, I have to risk almost 8 ticks. What's my profit potential at this time? Well, okay, is my profit potential at this time, determine, like figuring out from other market structure things, which the overnight high was at, I think, 13 or something, was my risk reward great enough at this time to make it tilted, a worthy risk reward, which has some market structure in it to back up, a stop where it's within market structure. Because at this time, if you got below this price, you could assume more bulls in there, and bulls from below the market would also want to liquidate, and then you'd probably be testing the intraday lows. Does that make sense? So every time you put a trade on, you want to consider, what's my risk compared to what I could make. So here's another good example as we're starting to break lower, right? I identified 12 as a line in the sand, and I said earlier, I don't know if you guys were in the room or not, I said, if they could establish prices below 12, which they have, we had a chance for lower prices. So in this chop here, that's happening here, everything that you were selling in here, your risk had to be above 12. And what was some of my downside targets? Let me show you something that I would use. All right. So if I sold like 11 or I'd want to sell it as close as I could to 12 because that was the line in the sand at the time, right? So I would turn to my profile and what is the, what do we have sticking out? Well, we have my profit potential was around 6, right? Anywhere between 6 and 7. So was me selling it at 10, risking to above 12, worth covering at 6? Yeah, it was. Now, it doesn't necessarily mean you're going to play out the trade completely like that, but it can give you a heads up. So if you sell like 10 even and it's hanging around 10 even and it's not really testing 12 at all, you're in there, right? Now, to the downside, you can also scale out some of your position and stuff like that. I don't know. I think the way that I'm talking probably isn't making much sense. But
no, it is to me. No, it is.
Constantly trying to figure.
It is to me, George.
You're constantly trying to figure out a potential place where the market is getting to, a line in the sand, and then, all right, so let's say the next line, you're getting ultra bearish now, right? And you think, well, this market, if it keeps breaking down, we're going to test 175, right? So where do I sell it? Where's the line in the sand? Well, I got this POC at 9, right? So if I'm an anxious short, this is kind of a lot of risk. I'd have to risk like 3 handles to get to 0175. So I don't really necessarily think this is a risk-worthy trade for me. All right. So I would be on the sidelines. If I was a bull, right, and I'm like, well, I'm going to see if there's some support below 0475, and then you'd have to risk to below 475. And then where's my upside target? Well, to come in short of 9 and test 8, which would be a test of the bottom of the previous consolidation. So that's a trade where a potential, like quick stop, like 4-tick stop, or a 2 or 3-tick stop is risk worthy, because you're just kind of fishing out there to see if anything happens. If it respects this as support, and if it does, then you got your chance to go to 8. So basically, you would buy 5, and then risk reward would be like 4 ticks for potentially 3 ticks. So that's how you're constantly using market structure to figure out potentially where the market is going.
You also go ahead, George.
You could also you place all the other charts together too. Well, okay, so this one, man, that's a heck of a thin spot to get to. Do I really, really want to try for that? It seems like I would be a sitting duck, right? Like this market really transitioned lower. I'm just giving you hypothetical things. I'm not telling you like I want to buy 475 to go to 8, even though it would work. Like given the look of the market, how it broke away from this consolidation and it's getting bearish. And before we left the room, I said, I don't like this market for going up anymore, because I wasn't very impressed of how it took out 14. I wouldn't be a bull. I'm just giving you hypothetical ways of trying to figure out your risk reward. You're constantly, you want to trade within the context of what's happening. I mean, really, really earlier, this here was the line in the sand, 12. We identified that here, this guy right here. They came in, they sold it hard, they couldn't get it to go right there. They leaked through it. You had to get some of them out. You blew it out, and then accompanied with what happened in the dome and the way the order flow happened, that's when you had the transitional move lower, and you can see it on the 4 PNF and all that. And then this right here was the identified line in the sand. And it never got back above it. So, that's ultimately if you were a position short where your risk should be above. Because if you go above here, you're going to test here.
And what was just going to happen, what I was going to say, you covered it perfectly with you bring it into the other charts, but in the thin spot, and that's where we're going to 08, maybe you could stand to get short at 08, but you're better off covering along at 08, because what we're going to do is we're going to trade through some of those 05s, which are bid 1,100 times, and then walk up to 08 and figure it back out. That's most likely scenario. And you're wrong, because I'm wrong. When I'm wrong, I turn around about a block when I'm wrong, not when I cross the other state line. I'm wrong below where you said. Those 75s, 4 quarters?
Yeah, 475,
yeah.
4 quarter in there.
Yeah, so I know where I'm getting out before I get in, and you're a little better off getting long and saying, okay, they went to the magnet, they traded 05s 123 times, and now you probably got some longs shook out there. They covered, they were mad, they got out, now it could go up, there's less sellers. And where's it going to go? 08, 09. I mean, that's just an idea for a trade, knowing, though, that number one, you want to take less risk on this trade because you're going against the grain. And you are taking less risk because it's below 4 quarter. Here's another thing, George. You could cover your shorts in here if you were short from above.
Yeah.
It's a great, awesome place to cover shorts.
Yeah, you got the big bid.
Go ahead and continue, because you're on a roll, and what you are saying is making a ton of sense. So continue.
I mean, if you're short against this 12 even and you're a position short, I mean, you got a naked POC here, you got a big bid in the book. I mean, there's no reason to not cover the short position, at least the majority of it, because who knows if, what if it respects this as this as support and wants to dig into, try to attempt to get up to here and test right here. Those are always the scenarios that you're playing out, and you stay in the market like real time. Up here, if you were selling it against the 12, this was your profit potential. Was risking above 12 worthwhile? If I sold 10 and I risked it to 12 half, that would have been a 10 tick stop. Was there still enough profit potential to 475, 5 even, for it to warrant the risk? Now, it doesn't necessarily mean that you have to risk the 10 ticks, but if you're a position short, would it be worth it? Yeah, it is, because it's 2 to 1. Does that make sense?
Yeah, Harry. Oh, shoot. Real quick, George. This is like you're playing against the grain, so you don't want to be either perfect, where also at 475 I get stopped out. You take out those 5 evens, perfect scenarios. You take out the 5 evens like they did, some big selling behind it. You could take a shot and get long here, keep a short leash of a few ticks. If you're looking for a bounce and you think it could bounce from here, you take a short or you get long in here. Okay, you risk a few ticks, but if you're not, it's a better trade if it could scoot above 5/4. And the reason why I say that is because then all this selling and all these, well, you can't see my screen, but all this red, we start getting above that red, and you create where you truly knocked off a lot of longs when they took out that 5 even, okay, and you got in some momentum shorts, and then you bounce a little bit. And you could walk up to the VWAP and maybe to 07 and 08, maybe. That's if you have a reason to buy it anyways. And if you're wrong in this spot, you shouldn't get killed. You can't stay long forever if it's hanging around here. But that's a scenario played over in your head. To cover a short if you're short, take a shot at getting long. But you're wrong now below 350 if they take those 350s. Overall, though, understand that you're playing it against this trend and down transitional moment that started at 12. I didn't mean to interrupt. I just seen that scenario where you could open up something quick and you're a winner above 5/4. Go ahead.
Yeah, I mean, just giving people the idea of, how to, you could still, basically up here I was saying, you could still risk less than 10 ticks. Okay, but just know that really you should be risking 10 ticks, because your stop should be above 12, at that time.
Get it, get your entry closer to that minus, so now it's a -5 instead of 10.
Yeah.
Work it better. Now you're working the idea. Go ahead.
Or know that you're late. You know what I mean? You're kind of late, so be quicker to take a -1 or a scratch. Does that make sense? Because you're like in here, you didn't have a chance to sell it at 12. Does that make sense? So you're more wary about it because you might be able to sell it closer to 12.
See, what would have helped you is never got.
Sense?
It makes complete sense.
Way.
It never got back above 5/4, and the Bears have stayed in control, taking those 5 evens out. It just kind of stayed below there. But even if you got long at 4/2, I guarantee you, if you're on top of it, you would have lost a tick or two or scratched it. It was taking too long. But all of it makes complete sense of knowing a real marker of transition and trying to work your trade to that. You're working it, instead of just putting in bids and offers to get long and short.
If you're fighting the move, you really shouldn't be in it anymore.
That's right here. If you were buying those 4.5s, you had to know you're fighting the move. Because all we've done is eventually take out all these POCs. You keep a short leash on that SOB, and you also know that you're not winning until it goes 5-quarter bid, 5.5 trade in that sequence. It hadn't. It just keeps walking down. Just know where you're at and know you need some things to happen. And being wrong 4.5, you're not still wrong, number one. But number two, it's like, well, you didn't have enough longs shook out. They were still coming. You didn't have enough stuck shorts on the low. That's the only reason why you're wrong. There's no reason to feel like they're pointing at you and laughing at you. This is a great session, I think, for me to be able to explain it and then listen to how George explained it. I would think this is one of the better sessions we've had. I've had guys tell me every time we do a session that that's the best one, that's the best one, that's the best one. I think this is a great one because you got kind of a couple different dimensions on how to figure what a good entry is and then use some short-term stuff to find better risk. And then if you're really struggling, get in where you would have got out and stop playing games.
Well, another idea is, all right, so you fought the move here, right? But you fought it just for a little bit because you knew, well, if you break this one and then you could end up this one, and this might be the better place to fight the move at 01.75. Does that make sense?
Not only does it make sense, but it's like you're still up for the next round. You know, you don't get knocked out. You get a couple, you take a right, you take a left, but you don't get knocked out and you don't get emotionally involved in the idea. And if you guys notice, we're explaining stuff from the notion of being wrong. A lot of other people would just want to talk about, well, look at this. You could be right. You could be right. We always go back to, well, what if you're wrong? Because you're not going to not be wrong. You're going to be wrong. You're going to shoot and you're going to miss. How do you react?
Biggest key to trading, really, guys, is not letting it get away from you. You know what I mean? You can't let it get away from you. You let it get away from you, you get emotional, you cancel your stops, you get wiped out.
Zane puts it well. Being wrong helps you be right. You can't win unless you could lose. It's in every professional sport. Nobody goes undefeated. Nobody has everybody has bad games, bad weeks, bad inside a game, right? You could be trading bad inside the day and get better. Just like inside a game, you can make adjustments to come out and play better after halftime or after because you know what puts you on the right track. That's why a strong kind of community is going to help. It does in a team environment and it does in a trading environment to create that team. If you don't create that team, the right team, you're not going to give yourself a chance to bounce out of a bad trading moment or two or week or two or something like that. Get back on track, get out of the rut ASAP. That's what's important. And what am I missing type of moments that you'll have. But these sports analogies are good because that's what those guys go through. But they don't have one coach. What do they have? Several coaches, trainers, teammates, right? If they just listened to their fans, they'd be tugged all over the place. That's like adding the losers because fans get you way too high when you're doing good and way too low when you're doing bad. You gotta listen to your support. And there is no support in this market. There's a transition. Everybody, we said this when we closed the trading room, was a bearish open just because we're opening up below the previous day's low has most people thinking we're going down. And sometimes we do. Okay? And it's called an opening drive, and most people missed that. That's why it kept going down, because most shorts missed it. When it doesn't go down, and it should, is when you get that upside. When you get that transitional moment at 13, 14, it goes down, and everybody who tried to sell it on the way up is trying to buy it on the way down on a day like today.
Or you got people that they might have even made money get longs in, and they can't adjust to the market changing.
Yes.
Just doing the opposite of what it did on the way up.
They did well from 99 to 14, and they've given some back from 14 to evens here for 02. So you could fight it and not have to get knocked down when you're wrong is the whole point. And if you're wrong in stacking days or months with your profit loss, then you're going to have to start getting in where you're getting out. Because the market's going to allow you to get out. Because it's knocking you out. Right? It's going to allow you to get in where you were getting out. And turn it around. Don't think like every time I bought it, I should have sold it. Don't do that. Don't do that. Because that ain't going to work either. Trust me. Don't do that. If you're struggling, start getting in on the same bias you have, but get in where you would have got out. And if you miss it, great. You'll review that at night.
Hey, you guys want to know like a good exercise? All right. So
jumping jacks?
Yeah, those are good. But no, listen. All right, we gapped lower this morning, right? Well, ideally, all right, if you walk into the day and you're like, man, I wish I was short from, and then you just sit back, when you filled that price in your head, I wish I was short from 13 on the overnight session. Let's give it a minute. Because the market kind of tends to go where it wants to find business, So today, if there was a lot of people, a lot of sellers on the sideline, right, and they're like, well, I'll just wait for it to get to 13. Does that make sense? So that'll make you like step back and take a pause and let you figure out what's happening, and you can watch the market as it like works and struggles, and then somewhere in between the market, between 10 even and 14 even, you're like, oh my God, it's really going to go to 13 where I originally wanted to short it at, and you're like, well, I could catch a long. Let me see if a couple of the order flow things will get me in there long, so I could profit as a long. Does that make sense? Kind of when you start the day, and you say, when I started the day, I'm like, man, I wish I was short from the overnight session, the highs. That was my thought. And then like you step back, and as the day develops, the morning develops, and then you're like, wait a sec, it's actually going to go there, and then you kind of get a bias, and the market will give you chances to get in where you wish you were in.
That's a really well said. Repeat the exercise again.
When you come into a day, right, okay, that's either like gapped higher or gapped lower, and you're anxious to do something because it looks like a lot's going to happen. If you say to yourself, I wish I was short from, or I wish I was long from, say the price, and then you step back and you watch the market develop, and because it's, a decent sized gap or a decent size amount of action from the overnight session, that's why you're saying you wish you were. Okay. You step back and you see, well, will this market give me a chance for my wish to come true?
And maybe you could actually get long as it's going up to your bearish target or your bearish entry.
Where you wish you were short or long.
Yes, you could get long up into where you wish you were short, because others that are short there are the ones helping buy it back up there and creating that temporarily bullish bias. It's a place where I don't advocate reversing, but it's a place where you could reverse. It's always better to exit a winning trade than enter a new trade. But you just got to be good at it.
You know how many people got smoked today saying, God, this market's so bearish. Man, I wish I got to sell it from, the overnight high. And, man, it went there.
Yeah,
and they sold it all the way
up. All the way up, yes, and that's why it went there. It's all self-fulfilling prophecy stuff. I think what you said is pretty profound when you say two things. You said you go, markets go where they want it, where it could do business, and it usually goes where you wish you were short from. Usually goes back to where you wish you would have been short. And those who are short from there help make it go there, and those who are anxious because they don't think it'll go back to where they wish they got short from get stuck short all the way up to that. Two self-fulfilling prophecy type of comments that you could understand the why of these markets outside of profiling. People think profiling gives them a better understanding of why. It doesn't. It's these opinions being executed, self-fulfilling prophecy scenarios. This is how you build the story of where the market's going. And, I just jot down notes because this falls under the day trading approach in the trading plan that I'm writing out or doing, meaning magnets for a bias, using simple delta naked POCs for risk assessment. So it could help you know where you're wrong when executing. Sweet spot risk reward, all right? If you're going to risk a couple, 3 points, I think that's a sweet spot for most of you, not necessarily for me, 2 or 3, a couple points. You don't want to risk too much more unless you're comfortable and to make what you're going to risk at first. I'm not a personality that likes to risk 8 ticks because I don't have the patience to stay in for 2 or 3 points. So it's hard for me to risk 2 or 3 points on everything. But a sweet spot is keeping it 2 or less, and then what George just said at the start of the day, think about where you wish you were long or short, especially on gap opens, but it doesn't just have to be on a gap open, higher or lower, George. It could be anytime. Do you notice that I never give a staunch opinion of where I think the market's going in the first half hour when we open the trading room? It's because I really don't know.
Yeah.
That's why.
Right.
I don't. And plus, I don't want to be like, I try to play it for where other people think is going to happen.
Yeah.
And it kept me from getting short. And it got me on the right side up to 14 eventually. But the whole key is too big of an opinion. It's harder to unwind that opinion. The market unwinds its opinion all day long. You need to be able to also. And we're kind of giving you some structure and some road signs along the way to assess better risk and to make better, decisions on the fly. Go back, a good coaching session to watch if you've up to speed with all the sessions is the market transitions on the website. That's a good one to look through. But you're right. The market will always go back to where it wants to do business. That's the magnet. It goes back to the magnet example. It's going to go. Why does it go there? Because it wants to? Because it has to. It's got to. If a lot of people did business there, it's got to go back to where they did business to close that business.
All right, let's do some real-time stuff here. All right, so we wanted to see if anything happened here, but this wasn't a very 8-tick worthy stop, right? Because you wanted to see, let's say for whatever reason you were bullish, right? But this was a scenario where if it broke this, it had a chance to go right here. So, yeah, I'll try it here, okay, but I'm not going to risk a lot because I'm against the grain. And below that, there's another spot where I could try again. And this is another one where your risk is small, okay? You don't want it to creep too much below this 175 because we already identified that, right? And you're against the grain. But what's my profit potential? Well, if we get above this high, right, maybe we're going to test this. So if you come up short, it's 4.5 is your profit potential.
I could tell you this. You could work this long because I think it's definitely going to 4. Again, it's a bias, but I think it's going to at least, even if it doesn't go to 6 or 7 or up much more than 4, there's a magnet at 4, 1,000 at 4. And if you remember, once we started leaking through 4.5, more longs started puking. 4/4. It's going back to 4 even is my point. The closest you can get to 175 or already be long, you could play that bounce. That's a great real-time scenario you brought up.
You know, we hypothetically gave it a fight here, but we didn't risk a lot because we're going against what's happening, right? We took our 2 or 3 tick loser, and then we're like, well, you know, I'm a determined bull. Where's the next spot where I'm going to, you know, try to see if it gives it, you know, I want to fight this move lower. And to me, it would have been this, you know, just simple PLC from a delta bar. And, you know, if I bought 2 even or 175, that's a scenario where you could have like a 4 tick stop, you know, and not even try to lose the 4 ticks. And since I'm risking 4 ticks, how many ticks can I make? Well, if we hold here and we get above 3/4, we're probably going to dig into some in here and attempt to get this, even if we come short, right, and we come up to about 4.5, 4 even, is it risk worthy? So if I'm long from an average of 2 even, you know, because I'm about 175 and I bought 2 even, so let's just say it's 2 even, risking 4 ticks, how many ticks can I make to, you know, 4 even, 4.5? 8. So it's like 2 to 1, okay? Well, I'm a little bit freaked out because it's taken a while, so I take the majority of my position off now, right? And I made a little bit, and now I'm just sitting back to see what will happen. And that's how you trade. And I think right now the key is this price, where it's at, this 3/4. If you bid above there, you're going to dig into some of this. And then you look on the book, and right at 4 even, you got a big offer. And, you know, you got some profitable longs that'll buy it up. Or not profitable longs. I mean, you got profitable shorts that'll buy it up. And the reason why you could assume that they'll buy it up is because of the sizes.
They went to those 4s. Yeah, they went to those 4s. They bought and bid 3.5, 3/4. Probably going to 5.
A lot of people probably want my chart now because it's
well,
like
it's scientific. Well, I just those 3/4 was a place to fade it. But there has to be a good magnet, and it was in the book 04. We were going to 4 because you could have just walked back and say after it goes from 4.5 to 1.5, you wish you got short where 4.5. Is that what you were kind of saying?
Yeah.
All right, because I was trading while you were talking, and it was like now it's going to go back to where you wish you got short. You don't have to get short up there, but you can cover a long up there. You can position yourself to work it.
Yes.
That's price discovery. That's price discovery / valuation. That's predictive skills. Good session, George. Thanks for your help. I'm going to cut the recording right now, so this session's over for you guys watching it on recording.